Hello, welcome to fasboyRambles by Fastboy Creative. I'm Fastboy, and today I'm going to ramble on the subject of debt. So far in some of the earlier episodes, we talked about how to determine success and what that means to you, and learn about how to accomplish things to contribute towards your success. We threw a little fun story in there about what it took to get my McLaren purchased, and really just hoping to keep your interest up. But today we're going to talk about debt. Now, debt is an important, necessary evil in your life. You're going to have to deal with borrowing money at some point or another, unless you've got plenty of money already. And if you did, you probably wouldn't be watching this series. I'm going to talk about three different types of debt. I'm going to talk about simple loans, credit card debt, and mortgage debt. And we'll spend a little bit of time talking about each of those, because I suspect that you will have to deal with those as you go, and more likely you'll have to deal with those early on than later on in your career. So if we start with the first one here, number one, the simple loan, that's the kind of thing that you're going to do if you go buy a car. You might decide that you haven't got enough money to buy the car that you need, and there's dealer financing and there's other things like that. But I'm just going to try and keep this simple and just talk about standard bank loans and credit card debt. So from the simple loan perspective, you go to the bank and you make a down payment towards the car. They're probably going to be looking for a 10 to 25% down payment on the car, and they'll finance the rest. And you might finance that across a term of 2, 3, 4 years. I understand today they might do up to even 5, 6, and 7 years debt, but I would encourage you to kind of stay away from anything more than about a 4-year loan, and try and keep it 4 years or less if you can. But the way that works, is you get that money and you go buy the car, and every month you make a payment, and the payment, it has a piece of it goes to the bank for interest. And so if it's a 7% loan or a 10% loan, then each year you're paying 10% on the amount that remains on the loan at the beginning of the year or thereabouts. And not a bad way to do it, right? But you're paying for the use of that money. That money really belongs to the bank. It's not really yours, and you use it to buy the car. So what the bank gets in return for that is the interest that you pay to use the money. So it's fair. It's part of doing business, right? So I'd encourage you, buy a car that's appropriate for the type of income that you have. Have a payment size that makes sense for you, and keep the loan term as short as you can. That's realistic for your overall budget, and make the payments and don't miss any, because that's a whole other problem that we'll talk about in future episodes. But if we talk about item 2 now, is credit card debt. I'm going to start by saying, just don't have it. And that might be easier, for me to say than for you to do. But I will tell you that credit card debt, there's very few situations where credit card debt makes sense. I'll tell you, the problem with credit cards is that the interest rates are extremely high, and they allow you to make a small minimum payment, which causes you to be paying a lot of money towards interest for the use of the money that you got from the credit card. It used to be that it was, I think it was during the Obama administration, they capped it at 21%, so you couldn't have interest rate on a credit card above 21%. Well, that's been raised. I think it's about 31% now. Please don't quote me on that, but it's a big number that doesn't make sense. It's a lot of money to pay for the use of the money. So if you have credit card debt, the first thing you need to do is get out from underneath that. So I wouldn't say don't have credit cards. Credit cards are an important part of building a credit rating. So you need to find yourself a credit card that makes sense. Ideally, find one that pays back points and things like that. Make sure you pay it off every month and use it to develop your credit rating. So if later on you do need to borrow some big money for some reason, that you have a good credit rating, you're able to do it. And above all, don't miss payments. Missing payments or defaulting on a loan is really one of the worst things you can do if you're trying to build wealth. All right, so we'll circle back to that at the end, but let's move on to the third type of loan that we talked about, which was a mortgage. And so if you're going to, most commonly you're using a mortgage to buy a home. And so, younger people who have been involved with that yet might not understand what the cost of the money is in the case of a mortgage for your house. Usually it's a 30-year fixed mortgage rate, and there's a lot of tips and tricks about how to manage that debt and do the best with it. And I'll give you a quick example. If you have a 30-year fixed rate mortgage and you make the payments every 2 weeks like you get paid, instead of making it once a month, it ends up being a couple extra payments a year, and it cuts that 30-year loan down to about 22 years. Okay, neat little tip. Not what we're here to talk about. What we're really here to talk about is understanding how the mortgage works. So what happens is you borrow the money from the bank, and in order to use that money, you make a payment back to the bank and attempt to pay the loan back, but they make the part that's called the interest. Well, same thing as the simple loan, although you it compounds every year. So if you borrow $200,000 to buy that house, in the first year you're paying your interest rate on 200,000. So if it's 10%, you know, you can do the math. You're gonna 10% of the money is gonna go to the bank to pay interest, and the way they calculate it is the full payment amount. You pay the interest first and the principal last. So the principal is the amount of money, is the money that you borrowed, and the interest is the amount that the bank's going to get. So you're paying a whole bunch of interest because it's the interest rate times the money per year 30 times, because you owe it for 30 years. So by the time you're down to 29 years, well, you're paying the interest for a year 29 times, and then you're paying the next year, you're paying interest for the year 28 times, and so on and so forth, till you get down to 30 years. So it ends up being a lot of money interest. I mean, hundreds of thousands of dollars. You know, find yourself a mortgage calculator online and just take a look at it once, and you'll see. So to sort of bring this full circle, I guess I don't have an expectation that you're going to be able to get through this wealth building process without a mortgage. You probably will need to buy something on a mortgage, and probably a house. So my recommendation is this: don't overbuy on the house. Buy a house that's appropriate for the amount of money that you have, taking into account, what the rest of your bills are, how you feed yourself, how you pay for your utilities. If you have a loan on a car, and maybe you have a significant other that also has a loan on a car, maybe you have college debt yet. So make sure when you buy that house that you don't overbuy, that you can afford to get that house paid for. And in future episodes, we'll probably talk about how to get that house bought right, so that you can invest in it and then resell it later and make money on in the end, because those kind of investments are good. But not today. Today's discussion is really about debt. So in closing here, I just want to sort of reiterate the three types of loans we talked about. We talked about simple loan, credit card debt, mortgage debt. Simple loan, probably fine. Buy a car, don't overbuy. Credit card debt, stay away from it like the plague. If you have credit card debt, stop everything else you're doing and figure out how to get that paid off. Turn that into some other kind of loan. Whatever you can do, get that credit card paid down, and then be more responsible going forward. I mean, it's just you're gonna have a very difficult time building wealth if you run credit card debt. The only exception I ever tell the people I'm advising with respect to credit card debt is, if things get busy at Christmas and you need to let the bill ride for 1 month, make the minimum payment, and then catch up on it after that. But those other 11 months, make sure you pay that card down on a monthly basis, and be very careful about that. And then again, mortgage, not such a bad way to go, but you are paying a lot of money for the use of that cash. And so don't overbuy on that house. And if you are buying something big, buy it with the idea that you're gonna be able to resell it and get some additional money out of it. So that's what I have to say about debt for today. And you're gonna need to manage your debt so that you can get on to the wealth building activities. And we'll talk about that more in future episodes, where we talk about, side gigs and how to generate some cash in addition to your usual, monthly expenses and things like that. But for this episode, that's all Fast Boy has to ramble on about, and we'll catch up with you the next time.